It's not about the rate hike because that was a foregone conclusion. It's really the Fed indicating that they're going to be two more. So one in September, which the market had priced in. Remember, the market was already talking about it. If you look at the Fed Watch tool, the indications were that 70% of the market believed there would be a rate hike in September. It was really an even call for December, but I think the odds would favor now another 25 basis points. So by the time we end this year, we would see 2.25 to about 2.5% on interest rates in the US, which is a stark different stance that we're seeing the Fed take in lieu of the growth numbers, in lieu of the inflation risks, and in lieu of the fact that unemployment is at record lows. So the global setup this morning is really to do with rate tightening measures, liquidity withdrawal measures taken by global central banks, because the ECB has also indicated they're going to continue winding down the QE program in Europe as growth numbers come back there. And of course, once again, it's really inflation which is top of the mind for most central bankers. Let's touch base with Michael Every, who's head financial markets research at Rabobank, joining us from Hong Kong with his quick review of the Fed stance. And Michael, indicating that there will be 4 rate hikes is the sort of surprise that the market was anticipating but not pricing in just as yet, which is why yields shot up beyond 3%. What does that really mean for the outlook that one would have on markets right now? Would it be really a trade where one would see money getting out of equities into fixed income markets, or this will fuel equities even further because these rate hikes come on the premise that growth has been very strong?
Well, I mean, why would you move out of equity markets into fixed income when rates are going up? I don't really see the logic to that particular piece of analysis. What does it actually mean? It means something and nothing, because yes, we saw the Fed shift very marginally to implying a net 4 hikes this year, not a net 3, so 2 more after this one. But all we actually saw was one dot in the dot plot moving from 3 hikes to 4, which carried the majority. But we don't know who that dot was. We don't know if it was a voting member or a non-voting member. So we actually don't know really whether the dynamic has changed this year. As a result, you saw yields spike, you saw the dollar spike, and you saw that reversed. So actually, the sharp move higher in both was unwound largely by the end of the day.
Michael, central bank has also indicated that there is not going to be 1 but 2 more rate hikes in the latter part of this year. Do you think that's going to take the markets by surprise, and are we really geared up to absorb 2 more rate hikes?
No, they didn't say that. Did you not listen to what I just said? They did not say that. The net balance of the dots shifted from 3 to 4, but only because one dot moved higher, which mathematically made the majority very slightly in favor of 4. But we don't know who that particular dot belongs to. On the dots, which show what the FOMC are thinking, collectively pulled together, some of them are voters and some of them are not voters. And it's not clear to the markets any more than it is to you or to me whether that particular dot belongs to a voter or a non-voter. It could be that the voters are still in the 3 camp. It could be that that non-voter is in the 4 camp. So we have to wait and see. And the Fed was very, very transparent that it will be data dependent. So if the data remains strong, then obviously they're going to hike in September. Everyone believes that. And if the data stays strong, then they'll hike again in December. If they don't, they won't. So we have to wait and see.
Michael, hi, this is Siddharth joining in conversation. Now, inflation at 2.1%, growth at 2.8%, interest rates now at 2%. And after many, many years, we are now seeing parity or somewhat parity between interest rates and inflation in US. Now, we are talking about 2 rate hikes or 3 rate hikes this year and probably more to come in next year. Now, as you know, there is an absolute, we are seeing less and less differential between interest rates and growth. Do you think this would impact US growth going forward, and that would eventually lead to some sort of slowdown?
Very good question. I mean, the key issue here is how far is too far? And, you can argue it academically one way or the other. You can look at inflation, you can look at nominal GDP, versus where Fed funds currently are sitting or where they think they're going to be at the end of this year, the end of next year. I think the most accurate way to see what the balance of opinion is still to look at the US yield curve. Look at the spread between the 2-year bond yield and the 10-year bond yield. And that will tell you how much the market overall thinks the Fed can still do before it goes too far. And the answer to that particular question from the bond yield curve is 2 more hikes. They're basically saying 2 more hikes and you get a flat yield curve. 3 more hikes, you go inverted, which is normally a recession signal. So the market is far less optimistic than the Fed. In the old days, everyone used to say never fight the Fed. Well, the market is fighting it right now.
Michael, thanks as always for joining in with your perspective on what this Fed move means and more importantly, the commentary which was hawkish and yes, just hinting that there may be 2 more hikes in the pipeline.